Hi, welcome. It's Mary Ellen McGonagle here with your weekly Edge show for Friday, December 9th. First up, today on our show, we will take a look at the current markets and where we closed the week. You're going to want to be aware of areas of potential support and resistance as we head into what could be a critical period next week. Beyond that, we'll go ahead and take a look at sectors and industry groups for signs of relative outperformance that took place last week despite the pullback. Also, headline news that drove price action last week, and data and headline news due to be released next week as well. And then last up, viewer question of the week. And it's all about what is driving certain areas of the market to outperform at this point, and can we look forward to that outperformance continuing? I'll share all of that and more as we move forward. From here, take a look at some of that news last week. We did see the ISM service sector rise for November. This is all about the hospitality index, and an increase in that index indicates an expansion in the economy, and certainly in one area of the economy. And we are at a point where good news for the economy is not great news for the markets. We did see the markets pull back at the beginning of this week. And again, all about Federal Reserve action in response to an expanding economy. They will raise rates, which is not good for the markets. We also saw factory orders rise in October, another expansion indicator. And then also today on Friday, wholesale price inflation showed as increasing, which is not good news because we're at a point where the Federal Reserve is putting policy to place to reduce inflation. Consumer sentiment also rose in November. Again, not another great thing that you want to see. Ideally, you want the consumers to be pulling and inflation subsequently decreasing. Next week could be rather pivotal here in the markets. We're going to get some very important, impactful news by way of the Consumer Price Index, a very closely watched inflation gauge for the Federal Reserve. Also, the Federal Reserve will be holding their meeting next week, and on Wednesday, at the end of that meeting, Fed Chair Powell will have a press conference, very closely watched for wording as it relates to the Federal Reserve's inflation fighting, interest rate increasing policy. Also next week, retail sales number and flash PMI, another inflationary indicator, will be released next week. So from here, let's go ahead and take a look. Where did we close the week? Here we are with the daily price chart of the S&P 500. And a couple of critical areas to pay very close attention to is the position of the S&P relative to these simple moving averages. We can see last week we did get that nice spike up above the 200-day simple moving average. That followed Fed Chair Powell's comments that they may reduce the percent amount of their rate hikes. The markets liked that, and it was pushed quite a bit higher on big volume. However, since then, we have given all of that back, and we've seen a now price under these key 200, 10, and 21-day simple moving averages. These each area had been acting as potential support. Now they are upside resistance, so that on rally attempts, they could find resistance to the upside. Ideally, we want to get back up above that 200-day simple moving average so that there really aren't any speed bumps or hurdles that would distract from further potential upside. As for support, we are going to keep an eye on this 50-day simple moving average, which is at 3,840. That's your next area of downside support. Beyond that, we would need to go into the October lows for that next area of support. So certainly on the lookout for price action if we get down around this 50-day moving average. Also, momentum-wise, the RSI closed in negative territory. It does say positive, but after the close, we did see it dip into negative territory. And then the stochastics, a faster moving momentum indicator, also in negative territory below 50. So very cautious on the near-term prospects for the markets at this time. I'm going to take a quick minute and share with you a view of the Nasdaq Composite, which has been weaker of late. This tech-laden growth index is now just at that 50-day simple moving average. We did not get up to that 200 or even close to breaking above it recently, so these growthier areas are continuing to overall come under selling pressure. Momentum by way of the RSI and in this case the MACD trending downward is also negative, so the Nasdaq in an even weaker position than the S&P 500. Let's go ahead, take a look at the ETFs. These are going to be the 11 sectors within the S&P 500, a 2-month daily price chart view. I've gone ahead and added an RSI, sorted it descending. So up here on this upper left quartile are your stronger sectors, and down here on the lower right are the weaker. The relevance here is you want to pay attention to this on a regular basis, ideally so that you can capture rotation as groups progress from these weaker areas up to the forefront, and then likewise rotation away from the stronger areas down into weaker. So first up here on the stronger side are very defensive areas. XLV is healthcare, utilities, and then we have staples. This is really indicative of the market's investors' sentiment at this point in time, uncertainty going into next week and beyond, and also recessionary fears are raising their head. So in turn, investors are turning toward these more defensive names that also offer a yield as a buffer. Down here in this lower quartile, we can take a quick look at energy because it had been in a very strong area for a lengthy period of time. We've now broken below key support, momentum in negative territory, so energy stocks are looking very negative at this point in time. Quick look here at healthcare and a very confirmed uptrend. We did see a bit of a pullback today, so we will be, of course, keeping our eye on that, but for the most part, healthcare is remaining in this stronghold area up here at the forefront. We can take a quick look at technology because it's such a big part and component of the markets, and especially the S&P 500. And we can see here's that spike last week following Fed Chair Powell's comments. The technology sector rallied right up to that 200-day and pulled back. In this next segment, we're going to take a look at other areas of the market, including the other broader market indices, again, all with an eye toward giving you a sense of where that relative outperformance is, and of course being alerted to weaker areas. So again, this 2-month daily price chart view, RSI, and then sorted in descending order. Let's take a look down here. I talked about energy being in a confirmed downtrend, a lot having to do with this steep deterioration in the price of oil. We're now down at $76, well below the low of any period for this year, so negatively impacting those energy stocks. But let's take a look at this outperformance that's shaping up here in gold stocks. This is an area that exhibited outperformance last week as well. We are seeing GLD in a nice confirmed uptrend, poised to break above that 200-day simple moving average, and then your outside momentum in positive territory. One other metal stock I want to share with you that's even stronger, and that is silver. We can see this nice uptrend here as it gaps up, moving higher. And as we progress toward the end of today's show, I'll share with you one of the reasons these two metal stocks are on the move higher. Semiconductors, kind of interesting that they're up here. The group did outperform the broader markets this week, and I will share with you two reasons why the semiconductor stocks are on not necessarily the move higher, but your momentum still hanging in here in positive territory. Not quite bullish on the overall group just yet, but there are names for your watch lists that you'll want to certainly be aware of. And then in between here, we can see some other metrics. The US dollar is by and large steady, but still hanging down below there in that area right at that 200-day simple moving average. So at least in a steadying period there. We also want to take a look at volatility. We can see that this week volatility spiked again, and we are now up above this 21-day simple moving average with that momentum poised to trend upward. Rising volatility, not constructive for the broader markets. And we can see this MACD black line up through the red, indicating potential further upside on that volatility. So from here, I mentioned that I would share with you areas of strength and why. So let's go ahead and take a look, because last week we did see earnings reports from several well-known companies that are really impacting the market, certainly over the last 5 days. Here is AVGO, that's Broadcom, a well-known semiconductor stock, and they reported their earnings after the close on Thursday. And let's take a look. A big gap up. The stock was up 2.6% on the day on very big volume. This particular move was in response to the company's earnings report that came in above estimates and really had other stocks within the semiconductor group also rallying higher on the news. So this is one of the reasons that we are seeing relative outperformance among semiconductor stocks this week. They were down less than the broader markets. And another reason that we can take a look at some of these other semiconductor names that are firming up here. Let's take a look at NVIDIA. Highly recommend that you get this stock on your watch list. So in the event that the group turns positive, I anticipate NVIDIA to be a performer, or actually an outperformer. We can see that the stock is in a very nice uptrend here, finding support at its shorter term moving averages, poised to break back above this key 200-day simple moving average. Outside momentum indicators are in positive territory, so that is quite constructive, certainly for that stock. But overall, the outperformance that we are seeing in semiconductor stocks overall is attributable to these heavier weighted names that are coming out with earnings that are not as bad as anticipated, and in some cases, management is guiding growth higher into next year. Another area that I mentioned that was showing outperformance, we talked about silver and gold. One reason is that China is continuing to reduce their COVID lockdown restrictions. And we can see this is MCHI, the ETF for China's stock market. Very nice uptrend. Their market was up over 2% last week, again, due to that easing of those restrictions. And China is one of the top importers of silver, as well as other metals such as gold. So this is one of the prime reasons you can see this gap up the prior week when gold and silver were on the move. We are continuing to see that uptrend in China as it relates to the lockdown restrictions being lowered, and then also talking about this dollar, the US dollar. So as the US dollar declines, that is a positive for most commodities, and we can see the dollar remaining at this low level is another boost for these metals, the gold and silver names. That's it for this week. Have a great weekend, everyone. I'm going to look forward to seeing you here again next Friday. Hey, Mary Ellen here with Simpler Trading. Thanks for watching the video. If you liked what you saw, go ahead and hit that like button and leave comments below. And if you'd like to be notified to future videos, you can hit that bell icon and subscribe. Don't leave without subscribing to my MEM Edge bi-weekly report. I do have a special trial offer. And for those who'd like to learn about trading live with us, you can go ahead to simplertrading.com to learn more.